What's the most important golden rule of property investing? Now, you're probably going to say location, location, location. And while many people would think that's correct, that's not what my guest Stuart Weymss is going to tell us today. Of course, as a property investor, it's easy to get caught up in the excitement of doing the research and finding a perfect location and then the best property and the best deal. But as you'll hear today, successful property investing is much more than that, particularly in today's complicated housing markets. Now, this is one of our summer series of shows where we're going to be replaying some of the previous special episodes, and I think you're going to get a lot out of today's episode. So rather than the normal 2 shows a week, over the month of January, we'll be sharing 3 shows a week with you, a new one to keep you up to date with the markets, and ones like this where we're replaying some of our previous episodes for the benefit of our many new subscribers. So let's get on with today's show. If you've been listening to my podcasts or reading my blogs, you'll know I have a number of rules. I have frameworks to help my property investing. Now, by having these, it takes the emotion out of investing and makes my results more predictable. But what's the most important of the many golden rules of property investing? Now, that's a question I'm going to ask today of leading financial advisor Stuart Weymss, who's written a book about the golden rules of investing. So let's see which of his rules he thinks has stood the test of time best and is most likely to make you a successful investor. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
What's the most important factor in your property investment success? Well, according to leading independent financial advisor Stuart Weymss, whose book Investopoly covers 8 golden rules of investing, the most important rule is the quality of your assets. But what does that mean? And it can really be as simple as that. Well, that's what I want to chat with Stuart about today. Hi, Stuart.
Hey, Michael. Great to be back with you.
Now, Stuart, I was interested in reading one of your blogs, and your blogs come out every week, as does your podcast, and you discuss similar things. And you said that the one property investment golden rule that's more important than everything else, and it's guaranteed, interesting word, to build wealth over the long term, is the quality of your investment. So let's start with the obvious question. What does quality mean?
To my mind, when in respect to investing in residential property, quality really means that a property will benefit from excessive demand. So supply is finite or even reducing, and demand is growing and definitely exceeds supply, and that's where you're going to get price growth. So just notionally, for example, if I own a property, I want to own a property that there is at least at any time 10 potential buyers for that one property, and those 10 potential buyers might be diversified. You know, some might be home buyers, some might be investors, etc., etc. But if you've got 10 people that are interested in your property, you're going to get some price growth. And even if something happens in the economy or sentiment or those sorts of things, well, maybe the 10 reduce to 6. But as long as you've got more than 2, you're going to get price growth. And it's also important that those people have the economics to pay more, you know, to afford to pay more than what the person did 10 years ago, 2 years ago, and so forth. So that's quality to my mind.
Well, you can't expect investment grade returns, wealth building returns from a secondary property, can you?
No, that's right. I think your returns are commensurate and completely in line with the quality of the asset. And it just stands to basic logic, right? I mean, it's like anything in life, really. If you've got a quality team member in your business, you know, the results are going to be good. If you go and buy a good quality car, it lasts longer than a very poor quality car. It's the same in lots of different areas in our life. And it makes sense then, if I want to reduce my investment risk and also increase my return at the same time, then if I level up on quality, the outcomes are always going to be better over the long run.
Clearly, that means that it's more important to own the right asset than to buy it cheaply, or even with regard to the timing of when you buy it.
Yeah, and we've talked about this previously in terms of price and the time when you enter the market and those sorts of things. Quality trumps all of those every day of the week. Like, if you're going to obsess about one thing as an investor, you should obsess about quality and nothing else.
Well, I think we're both on the same page when we discuss investment grade properties, and that's very different to investment class properties, those look-alike apartments that are built for investors. To me, investment grade property is one that will produce, as I said, wealth producing rates of return, which is above average rates of return in the long term. And really, that has a lot to do with the location and the demographics. And of the properties on the market at the moment, in my mind, there's probably less than 5% that I would class investment grade. And that's got to do with not just the property itself, but obviously its location as well. So one of the things, as we said, is supply and demand have to be in the right ratios. There's got to be more demand than supply. And there's also got to be a depth of demand. I guess if you talk about the share market, you want one that's regularly traded by lots of people, not one that fluctuates in value considerably just because there aren't many people interested.
Yeah, that's right. And there's plenty of those stocks out there, particularly some of those tech stocks at the moment where there's not a lot of appetite for them. And that's why you see prices fall. You know, the analogy I like to use sometimes, Michael, is that, you know, everyone loves diamonds, or at least my wife does. They're a rare commodity. But, you know, if we think about property as diamonds, what we're really after is the pink diamond, or even the blue diamond. Apparently that's the most rare. If you have a diamond like that, or a diamond that is exceptional quality in terms of clarity and all the sort of things that they measure diamonds with, they're always going to sell at a premium. They're always going to outperform the average. And that's what you really want to do, is you try and outperform the average. And I would argue it reduces your investment risk, because really, if I want to invest in property and I'm doing that to achieve a certain result, a certain return, well, the way that I can reduce my risk is make that more certain than less certain. And the best way to do that, I think, is level up on quality. Get a really good quality asset. If you want to make money out of diamonds, buy the pink or blue diamond. You're sure to make money.
Well, it's a bit like when you play the game of Monopoly. There are various locations on the Monopoly board, and everyone wants Park Lane or Mayfair, and not the ones at the other end of the board, the names of which I don't even remember.
Old Kent
pretty
Road.
Much the same in Sorry,
Old Kent Road, I think, is the really cheap
one. You get it for $2 or something.
Yeah, something
That's
like that.
right. In property, if you're looking for quality, in my mind, I'd be breaking up locations into four different categories. There are the discretionary locations. They're the most expensive locations in a capital city. The established money locations, where most of the residents have lived there for a long time, where many of them have paid off their homes years ago. And over the long term, this high quality sector, and we were only discussing this personally a couple of weeks ago when we were over at your place where you're wanting to put your next investment, those high quality locations that are going to outperform because of their scarcity. And look, we know the rich are getting richer, more than the average Australian, and they can afford to, and they're prepared to pay a premium to live in these locations. And interestingly, over the property cycle, these locations are sometimes a bit more volatile, Stuart, aren't they? But over the long term, that segment of the market outperforms other segments.
Yeah, that's right. And I think, I'm always interested to read analysis about property markets, and some of it is meaningful from a macroeconomic or social perspective when we look at the cost of housing and the average times earnings and the average wage increase and those sorts of things. But sometimes then economists will draw conclusions from that data to say, look, property can't keep growing at that particular rate. And at a macroeconomic level, they're absolutely right. If you don't have the incomes to support the growth's got to stop at some point. But that sort of analysis is good, as I said, for a social perspective, but it doesn't really inform us as investors about where we should be putting our money. Because the wealth inequality, unfortunately, is getting worse. It's a trend that's probably it's a too big a ship to turn. And in fact, I think COVID has exacerbated it even more. And it's a global trend in all developed markets. So really what we want to do is have an asset that's going to appeal to the top 20% in terms of income or wealth of Australians. And if you do that, then your growth is more likely than less likely to be above average.
Now, of course, this isn't a judge of people, but it's a fact that some people are earning more income and their income is growing disproportionately more, and they're going to be able to afford to pay more for their properties. And tenants, because of their lifestyle choices, who earn more are prepared to live there. Now, some people, Stuart, are going to say, yeah, but I can't afford the East Melbournes and Turex and Brightons in Melbourne, or the Rose Bays and Double Bays in Sydney, or equivalent suburbs in other states. So I'd then look at maybe looking at the aspirational locations. So there's the discretionary locations where you've got to have the money to move in. I'd be talking then about aspirational locations, the upper middle class areas, the gentrifying locations in our cities. And here again, you've got a wealthier demographic, often changing just the nature of the suburbs, and they make great investment areas too, don't they?
Yeah, exactly right. There's a ripple effect, of course, and an affordability effect, a flow-on effect when people get priced out of a particular area. They don't necessarily want to make massive compromises and move, 20 k's out. The location is more important sometimes than the accommodation size or the land size, and so that ripple effect will sort of move on. Also, don't spread your budget too thinly. If you're contemplating investing in two properties, and sometimes this is, might I say, sometimes it's driven a little bit by ego. Sometimes people, I want a 10 property portfolio. Well, that is a meaningless metric to my mind, because I can go out and buy 10 properties tomorrow in the middle of nowhere, but it's not going to get me any closer to building wealth. I'd invite people to forget so much about how many properties they own and just think about the quality of the equity they've got in properties. Now, more than one's obviously better, of course, if it's affordable and so forth. But what I'm sort of suggesting, I guess, is to say, if your budget's $1.5 million, consider putting that into one property rather than spreading across two.
Well, again, if we're looking at various locations, we talked about the discretionary ones, the aspirational, and what I hear you're saying is, well, avoid the cheaper, more affordable locations. Of course, this is where most homeowners and many investors start looking because they can afford it. And I know some have been advised, let's use that word loosely, to buy cheap properties or buy in those areas because they're growing, but they're often physically growing, all those growth corridors, but not necessarily capital growth. And the last area that I'd really be avoiding, so the two areas I'd be looking at are the aspirational suburbs and the discretionary suburbs, and I'd avoid the affordable ones. And, well, I guess I'd call the other ones, Stuart, the last choice locations. In every city, there are suburbs where people live because they've got no choice. No one wakes up in the morning and say, I want to live in those suburbs, but social circumstances force them to. So clearly it starts with location, but then, Stuart, you really got to get the right property in that location, don't you? So not all properties, even in those good suburbs, make good investments.
No, that's right. And that's where asset selection comes into its own in terms of importance, and getting really good quality advice from someone that's been on the ground for many years and really knows that market inside and out. I've always encouraged and counseled my clients to go and find a really good buyer's agent that has that knowledge. Because you don't know what you don't know. And you can take a checklist to an area, you take a checklist to a property, but it's part art, part science. I think we've done a podcast talking about that. So it's the art bit that the checklist isn't going to get you across the line. So it's important that, that the accommodation works, the floor plan's right, the orientation's good, that you've maximized the land value component. There's lots of things you need to consider. But really, if I was a layperson wanting to invest in property, if you want to increase your investment risk and increase the probability of making a mistake, then do it all yourself. Now, if you don't want to do that, then obviously you really do need to lean on someone that has many years of experience buying in the market that you want to buy in.
Well, again, not all properties are investment grade. So A-grade homes and investment-grade properties are likely to perform well this year. Last year, you could buy almost anything, almost anywhere in Australia, and it went up in value. And I think last year was a lot driven by FOMO. People took shortcuts, Stuart. They bought on main roads. They didn't do their due diligence. And the market was, I guess, covered up their mistakes. I can't see that moving forward, that it'll be the same this year.
No, and if you're particularly worried about a property price bubble, then really do avoid those secondary and lesser quality locations. I was at a family wedding a few weeks ago in Shepparton, which is 150, 200 k's north of Melbourne. And we're talking about property, as we always, as you tend to do in social situations. the price of homes in Shepparton for like a new home in a new development area, probably a largish accommodation, I'd imagine, was 800, 900, even $1 million. I just couldn't believe it. I thought, well, who's paying $1 million to live in Shepparton? Look, it's a nice place.
It's a pretty place. I like it.
Yeah. I mean,
I wouldn't
live
pay
there.
$1 million.
No, but you're not going to pay $1 million. So when we talk about where the price bubble is, and you look at a house on 150 square meters in Toorak and it's selling for $2 million, and then you look at a new build property in Shepparton and it's selling for $1 million, to my mind, one you can get your head around the value proposition and its potential to double in value over the next 10 to 15 years. And the other just looks like a bit of a bubble to me, frankly. Now, it might not be. It might be that there's enough demand to at least sustain that price, and you probably won't get any growth, but maybe it doesn't fall. Maybe the bubble doesn't pop. But really, if I'm investing and really I'm focused on long-term outcomes, then I want to invest in the asset that has the greatest fundamentals and probability of doubling in value over that time period.
Well, that then falls back to what we discussed before about the concept of having diverse demand and also people who are prepared but also able to pay for it. So let's maybe look at some of the factors that drive demand. And I think over the last couple of years, that's changed a bit in that neighbourhood has become very important, and the concept of a 20-minute neighbourhood being able to drive, walk, ride close to, having a choice of good amenities. So amenities are very important in looking at what's driving demand in a particular location, Stuart.
Yeah, that's right. I mean, it's all sort of logical stuff. If we think about all the things that we would like in a location, they're the sorts of things that the vast majority of people will like as well. So amenities are important, particularly around social and entertainment, parkland, ability for, kids to have some parkland, a walking track, all those sort. Even if you don't have kids, for example, the whole point is thinking about having a diverse demand set of different demographic for your particular property. So you've got to think about, people with kids, people without kids, older people, younger people, et cetera, et cetera. And you want enough amenity in that area that's going to satisfy, most of those demographics. It may be impossible to do all of them, but most of them.
You also, schools are very important. Good public schools, good private schools, proximity to schools can add a lot towards capital growth, can't it?
Yeah, I mean, school zones drive property prices in lots of different areas, particularly Melbourne, Sydney, Brisbane, really across those three capital cities, that they are very important considerations. And again, if it's a home, for example, because I often try and counsel my clients to bring an investment lens towards a home purchase. So even if I was going to go buy a home and let's say I didn't have kids, I would still be thinking about school zones, because the next person that buys my property might be thinking about those sorts of things. So it's always good to think school zones, whether you're an investor or whether you're an owner-occupier, irrespective of whether you have kids.
Of course, beach, proximity to beach, water, sand belts, that is always a strong driver for the wealthy. And in the past, it used to be proximity to the CBD. That doesn't seem to be as important at the moment. It'll be interesting to see which way that trend moves moving forward.
Yeah, and I've got a strengthening opinion that the whole work from home thing will have a substantially less impact on our choices moving forward than what others might think. I think the work from home thing has certainly changed the way we work, and certainly at the fringes. And I'm really talking about more of a hybrid model where people might work from home a couple of days a week. But at the end of the day, and we're kind of seeing it through conversations with clients already, at the end of the day, the CBDs in capital cities will offer the most amount of employment opportunities and career opportunities. And you can imagine a situation where you're in a team, you're working from home all the time, and then your colleague is in the office all the time. Now, the colleague's going to get mentoring, they're going to get opportunities, they're going to get better training, they're going to, all those sorts of things. There's going to be a time where you go, well, what am I missing out on by working from home? So you've either got to work for an organization, to my mind, that's completely at home, and then everyone's on a level playing field. But if that's not the case, I think in lots of different industries, we're going to go back to more of a be in the office sort of model. And therefore, being close to a capital city is always going to provide those employment opportunities. Now, again, you got to think outside the square. So if you're in a employment opportunity that actually works fantastically well working from home, that's fine, right? But don't necessarily make your property decisions based on your own personal circumstances. Think about what
this is if you're talking about investment in some ways. If you talk about your home, clearly those things are important. But even when you buy a home, for most people, it's not their final home, Stuart, is it? It's not their forever home. So they should still have all these things in the back of their mind.
You know, I'm an accountant by trade, a financial planner. I'm a logical person. And when I go and buy a home, I'm always thinking about what the exit value might be, how I'm going to maximize the outcomes and so forth, which is not to say that I don't prioritize lifestyle benefits, of course, but I'm thinking about those things, right? So I just think the work from home thing is an interesting one, and it could be a trap for people to make property-based decisions, assuming that we're all going to work from home forever, because I think that's erroneous.
And moving forward, as we're going to get millions more people into our country and thousands, hundreds of thousands of more cars in the street, I guess public transport is going to remain an important factor. So you're going to want to be close to, but not right on where the public transport is.
Yeah, congestion, I think, is a complaint for anyone that lives in any capital city, maybe with more than 3 million people in it. Travel times and congestion and so forth. It's only going to get worse. There's only so much infrastructure. It takes Australia too long to build any sort of infrastructure project anyway, and there's only so much that we can build. And I've made a comment before, I've written previously before, Australia just doesn't have enough taxpayers. There's only about 15 million taxpayers in Australia. There's not enough to fund the infrastructure burden. So we're always going to be behind the 8 ball there. And so proximity to CBD and all the amenities that we talk about start to become more and more important, particularly as you even you move further out. Because if you move out 50 k's from the CBD, you could be looking at an hour and a half drive eventually to get into the CBD. It starts to become problematic, I guess, from a livability perspective.
Now, in your great book, Investopoly, as I said at the beginning, and I would recommend anyone gets that, you've discussed 8 rules. I want to discuss one more. But before we discuss this other, which I believe is another very important rule, let's have just a quick talk about your book, Investopoly, which really has proven to be timeless. So despite the ups and downs of the property cycle, the geopolitical problems, the wars, your rules have actually stood the test of time. So how can people get a copy of that book, Stuart?
If you just Google Investopoly, that'll take you to several links, including our website, Pro Solution. And if you use Yardney, the code, so your surname, Michael, it'll discount the book. We won't charge any postage, and it's just $20. So people can grab a copy. But you're right, Michael, the whole point of writing the book was that I believe investing is really easy if you just follow a few simple rules. And those rules are rooted in sound logic and an evidence-based approach, which means that I can point to all the evidence of why those rules work and why going against the rules don't work. And quality is one of those things that, it's not one of the rules, but quality is one of those things that is based on sound logic. We kind of understand where the returns are coming from if we've got a really high quality asset.
Now, Investopoly is obviously also the name of your podcast, and wherever people are listening to this podcast, I'd recommend they subscribe to. Actually, subscribe's the wrong word now because it doesn't cost anything. But download favourite Stuart's Investopoly podcast. Now, you mentioned Pro Solutions. You mentioned also that you're an accountant, but you're much more than that. So before we get on to this, I think other very important rule I want to talk about, if people want to get the benefit of your depth of knowledge, what does Pro Solutions do?
Well, we like to inspire clients to take a holistic approach to building wealth. And the reason for that is that I believe that there's lots of different considerations in any one financial decision. So, for example, investing in property, I think about financial planning, cash flow, strategy. I think about mortgages. I think about tax outcomes. And all these matters are important and often interrelated. So our approach is to build long-term relationships with clients and inspire them to adopt this holistic approach.
In a simplistic way, you're an accountant, a financial planner, and a mortgage broker, but that's saying it very simplistically. What you're doing is actually bringing them all together, and that's the holistic bit.
You said it much better than I did.
So, prosolution.com.au. Now, in your book, Investopoly, let's discuss the other important rule, I think. Well, they're all important, but playing the long game. Tell us about that.
Yeah, so I think it's really tempting, even for seasoned investors, to get distracted by short-term opportunities. And there's a guy called Howard Schultz who built the Starbucks empire. I was listening to an interview once, and he said that short-term profits never drive long-term value. And it's kind of one of my favorite quotes, because really at the end of the day, if I have a stock tip and I can make 10 grand over the next week, that's great. That's an awesome outcome, right? No one's going to say, no, I don't want to make $10,000. But is it really going to change my life? If I just do that once, in 10 years' time, will I be in a different financial position? No way. It's immaterial. It's never going to change my life. But if I make a decision today to go and buy a particular property that actually might drop in value over the next year, let's just assume that, but in the long run produces really good returns, is that going to change my life? Absolutely. I'll be in a materially better financial position in 10 years' time. And Warren Buffett has that saying, if you're not prepared to hold the investment for 10 years, don't hold it for 10 days. And it's really play the long game in a different way. So, but I believe that really the focus should be on making decisions that put you in a much better financial position in 10 years' time, and ignoring the financial decisions that are focused on what might happen over the next 12 months.
Now, I know being an accountant, you love spreadsheets and charts, and so I'm going to leave a link in the show notes to your blog on prosolution.com.au regarding this, where there are some charts showing the difference between short and long-term gains. While they're intuitive, but maybe give us a couple of other reasons why short-term opportunities are inferior.
Yeah, I'll give you three. The first one is we got to think about risk-based returns. So it's good to think about return, but then if you can't consider different returns without considering, or different investment options without considering their prevailing risk. So if I've got the chance to make $10,000, but I've got an equal chance of losing $10,000 over the next week, compared to a different opportunity that only makes me $1,000, but it's almost guaranteed. Well, when you factor in the risk to those different opportunities, the $1,000 profit looks a lot more attractive. And so by playing the long game, it forces us to focus on fundamentals and drown out short-term noise. You know, what's happening to interest rates, what's happening with the Ukraine conflict, et cetera, et cetera. These are all concerning events, of course, but with respect to making investment decisions, they're less likely to be impactful over the 10-year period. What's more likely is population growth, supply, demand, some of the things that we've spoken about today.
The demographic changes too, sure, very much so.
Yeah, so by asking ourselves, will this matter in 5 or 10 years' time, it allows us to really focus on what are the key fundamentals, and that invites us to make a better quality decision. Whereas just focusing on the return, not worrying about the risk, is a fool's game. And so that risk-based return element suggests that playing the long game gives you the highest return for lowest risk. The second reason is you want to benefit from compounding capital growth. You want an investment that can give you, on average, not every year, but on average, a 7 or 8% return over a very long period of time. And that builds tremendous wealth, certainly in the first 10 years, but substantial, ridiculous wealth over 20 and then 30 and so forth. Whereas if I'm just chasing short-term investment opportunities, firstly, I've got to make those decisions consistently, right? So every stock pick I pick to make $10,000, it's got to make $10,000 every single time. And then once I've finished with that investment opportunity, I've got to jump to the next one. I've got to find the next one.
You've got to find another one. That's the hard bit sometimes, isn't it?
It's just impossible. I mean, no one, the statistics in the share market, for example, demonstrate that no one is able to do that longer term. And the last one is taxes. Every time I make an investment and then divest of that investment, I need to pay some tax if I'm lucky enough to have made a profit. Whereas if I'm investing in something like residential property that compounds in terms of growth, and most of its return is provided in capital growth, well, of course, it's taxable eventually, But at least between now and when I sell the property in 10, 20, 30 years, I can reinvest that compounding capital growth. And so by not taxing, not giving away half my profit back to the government every year or every time I sell an investment, I'm much better off compounding even on an after-tax basis.
The problem is a lot of people are looking for excitement in their property investing, Stuart. They want to buy and sell. They want to buy and flip. We see people coming to us saying, I want to develop a property and sell it so I can do a bigger one next time and a bigger one. And we actually discourage that. That's not the way we suggest you invest. It's too hard and the tax man takes too much. But I guess it's a bit of human nature that people looking for excitement, I suggest they should go bungee jumping or trail bike riding. Don't look for your excitement in your property investing.
You know, there's two primary emotions that can drive investment decisions: fear and greed. And, you know, the fear is, well, if I buy this asset and I really hang on to it for 10 years, what happens if it doesn't work? Maybe I'm just better off making a short-term profit and banking it because that feels like I'm making progress. And then the greed element is, well, look, here's a short, quick-term hit, a sugar hit, if you like. I can make this profit and then I can think about making some long-term decisions. The reality is that there's a right and wrong approach. And the wrong approach is wrong every single time. And the right approach is right every single time, right? So, yes, it's attractive, you know, if I think, you know, and it is tempting. It's, as I said, it's tempting I get tempted sometimes. I look at something and think, oh, that's a good opportunity. Oh, that stock is totally undervalued. I should go and buy some of it.
What about Bitcoin? How about that?
Yeah, you know, trading Bitcoin or doing something like that. And it is tempting, but then you've got to remind yourself to really focus on that question, that 10-year horizon. And I think it's something that Warren Buffett gets quoted so much, but I think it's something that he has been absolutely disciplined about. And that's the reason why he's in the situation that he's in. Whereas there are some even billionaires that are kind of fly-by-nighters that, you know, that are lucky one-off and they've made some short-term decisions but don't hang on to that wealth.
Well, Warren Buffett wisely said wealth is the transfer of money from the patient to the impatient. But I saw in your great blog that you added something to it, which it makes even more sense. You said wealth transfers to the investors with most patience and discipline. And it takes discipline to delay gratification and be patient, doesn't it?
Oh, I mean, definitely. As I said, I get distracted at times as well. And luckily, I mean, I'll stick to my own, you know, I eat my own cooking. I follow my own rules, of course, but it is tempting, right? It is very tempting. I was talking to an experienced investor yesterday, in fact, and he was mentioning about interest rates and money supply and will things slow down and those sorts of things. We've got to separate logic from emotion because he knows logically that's silly. Like in the long run, interest rates are going to change over the next 10 years. Interest rates aren't really that important when it comes to property values. So he knows logically that's a silly sort of argument, but his emotions are getting in the way. His emotions are worrying about these things.
We're human.
Of course. And we've got to acknowledge those things.
Even accountants.
Yeah, even
you do have feelings.
Maybe not all of them, but some of them have feelings. You know, we've got to acknowledge those emotions. That's fine, right? We all have them. We all think the same way to some degree, but just acknowledge it, I think, and call it out and saying, well, what am I feeling here? Is this a logical, sound, evidence-based rationale for making this decision, or am I just a little uncomfortable? And it's okay to be uncomfortable, but just don't make investment decisions off the back of it.
Fantastic. Well, look, thanks for working through two of your golden rules, the importance of quality in your asset base and playing the long game. I'm sure that's going to give the listeners to today's podcast some great foundations moving forward. And I look forward to catching up with you again in a month and having our regular chat, Stuart.
Fantastic. Thanks a lot, Michael.
Following on from my chat with Stuart, I guess I'd like to explain that I still see 2022 as being a great year for property, but it is a year that you are going to have to follow some of the rules. I remember last year you could buy almost anything and your property went up in value. It was an unusual year. We experienced a once-in-a-generation property boom where values grew strongly almost anywhere. Around 98% of locations around Australia recorded rising property values, and in many locations properties went up more than 20%. But this year, 2022, is shaping up to be a more normal market where some locations are still going to see strong property price growth, some will experience moderate growth, and some locations, their language properties are going to hang around much the same price, and a few locations are going to see falling property values. And this is going to be affected by local supply, demand, and local economic conditions, because we're still going to experience the same general macroeconomic factors, the same interest rates, same tax rates, the same geopolitical problems. So this is going to be a year that applying the time-tested rules are going to be very important. And that's why at Metropole we have a set framework to help our clients grow, protect and pass on their wealth, but not just to create wealth, to create life-changing wealth, and for many people, intergenerational wealth. That's why I believe today in this market, you're going to need to have a team on your side that gives holistic advice. You're going to need more than just a property strategist. You're going to need more than a buyer's agent. You're going to need a holistic team that starts off by putting a strategic plan together for you to plan to become the person you plan to become. And with all the things that are happening in the world, I guess you've got a plan for your plan not to go to plan. And that's not just a play on words, but by having a plan, by observing the golden rules, by having a framework to work through the challenges, you're much more likely to be in that 1% of investors who ends up with a substantial property portfolio. Remember, only 1% of investors ever get more than 6 properties. And a lot of those who have 6 properties in their portfolio have a few duds as well. If you want to stack the odds in your favour, why not have a chat with the team at Metropole? My team at Metropole, who've won multiple awards but have got a strong track record of working through good times and challenging times in the property market. Go to metropole.com.au, find out about our range of services. Why not have a chat with my team? I'd love to be part of your wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today's mindset message comes from a blog post by Dan Peterson, who wants to remind us about the importance of living in the present. It's a reminder to slow down, to breathe, and to realise the infinite potential that you are. He said, we're all trying to get somewhere, to a place where all our needs, all our desires are met. We all just want to be okay, to have a meaning, to be valued, to be at peace, to be happy, and to have fun. This is what we all chase, but most of the time we don't have it because we chase it. The chase clouds the moments. The chase blinds us to what we already have and to the availability of the peace in the here and now. The chase is a way of running from ourselves, said Dan Peterson. We can't have everything we want, but we can have peace. Not just on the weekends or when we retire, but right now. Not at the bottom of the bottle, not through a paycheck, but within you. It's available to all of us right now, said Peterson. So he suggested, take it one day at a time. Deal with what's in front of you right now instead of focusing on what hasn't or what may not work in the future. Things usually don't turn out the way we imagine they will, but they usually turn out the way they should. Right now is the only thing happening, and this is where it must end. If you make the best of the present, you'll make the most of your future, says Peterson. It's good to have goals and have a vision for the future, but don't let it cloud the moment. Anything worth accomplishing in the future is no more valuable than what you can experience at the present moment. Peterson said, death may come before our goals and dreams are accomplished, so don't forget that life is right now and may only be right now. What is worth doing or experiencing right now? What is worth the very little time you have left? Now, there's some interesting thoughts from Dan Peterson where he correctly says you've got to be grateful, you've got to be appreciative, you've got to enjoy what's happening. Now, he's not saying don't make long-term plans, because if you don't have goals, if you don't have plans, you're not going to get anywhere. But I think what he's trying to tell us is enjoy the journey, because if you don't enjoy the journey, you're not going to appreciate the destination when you get there. Well, Stuart delivered a whole lot of gold nuggets in today's show, didn't he? So now you understand some of the rules that are important to help you in your property investment and your financial success in general. And if you got some benefit from our discussion with Stuart and you know somebody else who, like you, would like to become more financially independent, please tell them about the Michael Yardney podcast. You'd be doing me a real favour, but you'd be doing them a favour as well. My aim is to make as many people as financially fluent as possible. Of course, you can tell the world by leaving a review wherever you listen to this podcast. I'll be back again real soon, but you can catch me in between on social media. Just look for Michael Yardney, and you can always be part of my private Facebook group where each day I leave some tips, some tricks, something a bit different I don't leave elsewhere. So go to Facebook and look for the Property Update private Facebook group, and I'd love to share my ideas with you as well. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?